Agriculture in the northern region is mostly rain-fed and is once a year within the farming season, with most farmers recording lower yields. Due to this, most financial institutions in the northern region are reluctant to extend credit to smallholder farmers for lack of poor bookkeeping records, lower yields, lack of collateral, whilst other SMEs in the region also require farmers to contribute above 20% to qualify for loans. Some smallholder farmers also complain of high interest rates on loans charged by financial institutions. To improve access to long-term financing as well as enhance sustainability, a finance officer for Alliance for Green Revolution, Mr. John Wakiumu, noted that there is a need for training in risk diversification among stakeholders in the financial institution as well as building their capacity of the farmers to improve yields to make them viable.
The other thing is that the financial institutions need to have some sort of risk sharing mechanism to enable them to tilt into that sector. They have an interest in lending to the agricultural sector. They have an interest in building their portfolios and growing their portfolios in the agricultural sector, but there is always a gap in between when it comes to risk perception. So capacity building is for banks to understand how to lend to the smallholder farmers, how to lend to agri-SMEs who may not necessarily be bankable at a particular point in time, and the capacity building for agri-SMEs and smallholder farmers for them to understand issues of credit, for them to understand financial literacy so that they can make their own budgets, so that they can understand the importance of repaying loans, so that they can understand how to grow their farming activities at a higher production level.
Mr. Wakiumu therefore recommended for the formation of FBOs in farming communities to minimize the risks associated with lending to smallholder farmers.
So the ideal way of actually financing the smallholder farmers is if they are organized into groups, into farmer-based organizations, which makes it easier for them to actually, number one, access services from development partners. But for purposes of actually financing the agricultural sector, if they are organized into farmer-based groups and then one particular loan is disbursed to the group, and then the group is responsible for purchasing the inputs for all its members, and then the group actually pays the loans once they harvest as a group. That lowers significantly the cost of delivering the loan to the financial institutions.
Mr. Wakiumu further noted that through Danida, $30 million will be assessed by smallholder farmers as mid-term loans for a period of 5 years starting for 2014 farming season. Nash for Versa One News.